The Federal Reserve shakeup may end up changing the timing of when and where we invest for HouseHack. In this video, I'm going to be covering multiple updates about not only how the Federal Reserve will be affecting us, but also how Gerber is taking our money. We'll also talk about where we're thinking about investing. I've got some very large updates for you as well if you're a non-accredited investor. This is a very big deal, and I have a lot of good news for you, so I'm very excited to present that good news for you in this video. I'll also be covering some other Q&A that's been posted in the Discord chat. If you have not yet joined the Discord channel, remember, you at no cost can chat with me by just typing into your browser metkevin.com/chat. If you go to this, it'll redirect you to our Discord. And if you tag me there, I regularly look for individuals who've tagged me in Discord, and you could leave questions there. So remember, metkevin.com/chat. Now, do keep in mind that tomorrow is the end of the month. Tomorrow is October 31st. And at the end of every single month, we do have a deadline. That deadline is how many warrants, which are kind of like call options, you could get by investing in HouseHack. The earlier you invest, the more of these essentially call options you get. But because they're with us, they're a warrant, and all of those are broken down in detail, of course, in our PPM at househack.com. But basically, if you are not a course member, you can get up to 50% warrants on October 31st. And if you are a course member or you take advantage of that Halloween coupon code expiring, then you get an extra 10% in warrants. Now, this will also be applicable for non-accredited investors, and this is where we've got some news coming up. But just to finish this, as long as you sign your subscription agreement by October 31st, you'll be eligible for these warrants. This is basically an opportunity for you to double down in the future on your investment. Maybe not fully double down, but add an extra 60% to your investment, maybe 2 years from now, at the original day one valuation, which is a really great opportunity, not just for you to increase your ownership within the company, but also for the company to raise money after we've deployed a certain set of money, allowing us access to more deals. So it's really win-win. It's win-win for the investors, and it's win-win for the company. It's basically like having a larger first-round founder-run investment pool, which gives us more capital and more buying power and more leverage. So every single month, quickly, as long as you wire by November 4th, you would be eligible for this, right? So you sign by the end of the month, wire by the end of the first business week, and you're good. At the end of the next month, which will be November 30th, we'll be down to 40% plus 10. And then at the end of the year, we'll be at 30% plus 10. So you could kind of see the incentive of funding earlier here. And this is where we get to non-accredited investors, which is quite exciting. Non-accredited investors, we hope will be able to launch in January. Worst case, it'll be February. So in January, this would look a little bit like this. January 31st, 20% plus 10, or February would be 20 is next year, leap year, 29th would be 10%. plus 10. So you actually still have somewhat of an opportunity to get in on having these call options. But the big thing is we're expecting non-accredited investors to be able to invest at the same founder valuation, which is very exciting. That same founder valuation where $1 equals $1. And this importance can't be understated. Let me give you an example. Mr. Beast, everybody knows Mr. Beast on YouTube, is looking to raise $150 million at a $1.5 billion valuation. That means you put $1 into this company, your share is only worth approximately 10 cents of what the actual shares or actual money raised is. The other 90 cents is going towards sort of the imputed value of the company, right? So this is actual cash, and this is the imputed value of the company, assuming the company is solely value and is, let's say, out of cash, right? Just to make this simple. Let's say there's zero cash at the company. and you put $1 in at a $150 million raise with a $1.5 billion valuation, that means 10 cents of your dollar is going to actual cash and 90 cents is going towards what you think that company is actually worth and their potential future earnings, right? To make this very, very clearly different, at HouseHack, for every dollar we raise, the valuation is $1. That's why 1 for 1. This is what's known as selling founder shares. And founder shares have 0 of this upfront dilution that you'd actually be seeing over here, which is generally what you see at other companies when they raise money, is you see some form of upfront dilution, very, very typical because they're an operating company. We believe because we're not actually an operating company yet, we believe we're only raising money at net asset value, and we think this is most fair to our investors. And keep in mind, my goal, quite frankly, this is also somewhat just sort of like another goal of mine, is I want initial investors, whether you're accredited or non-accredited, I want initial investors to think, wow, Kevin really made me a lot of money. I want to do another deal with Kevin, right? Look, I'm 30 years old. When I'm 35, I want to be doing this for another 30 years. And if I screw people early on, that's terrible. That's a terrible way to set yourself up for investing in the future with other individuals, right? So what's important as well, just briefly to remember, is if you are an accredited investor and you want to get in before the non-accredited rounds, remember, we actually don't need that much from you. It's relatively simple. If your income as an individual is over $200,000, just send us your W-2s or your tax returns for the last couple years. If you're married, it would be $300K. Just send your tax return and your W-2s. You just go to househack.com, click Apply to Invest, upload the documents. Simple. If you need to get a letter, you could get a letter from a CPA or an attorney tomorrow and just fill out the form tomorrow, October 31st, and send your money by the end of the week, and you're good. Alternatively, if you don't want to send us your financials, just get a letter from househack.investready.com. Okay, so what's the news for non-accredited investors? Well, this is actually really exciting. We are in the process now of getting our audited financials. This is a really big deal. The SEC requires audited financials, something that's actually not required of a regular accredited investor fund before that. So all of our financials are now going to get audited, which I think is actually excellent and should just be required for all sorts of funds, but they generally aren't. Anyway, all of our financials are getting audited, and of course those will be made available once they're complete, and we launch our Reg A fund. Our Reg A fund, I'm pushing really, really hard for January. And the cool thing about this is this means if you do not have a net worth exceeding $1 million or your income is less than $200,000 a year, less than $300,000 a year as a couple, that's okay. You can invest. You would be able to invest up to 10% of your own self-certified net worth. We do not have to verify this. You can do this with your own attestation. Obviously, do the right thing. But with your own attestation, the point of me saying this is that I don't have to verify your assets and things like that, right? Which is good. It's less work on HouseHack. But the goal is, in January, we can launch this, and you can invest up to 10% of your net worth. And the neat thing is, you can, if you are a non-course member, you're just a viewer, the minimum investment is going to be $20,000 with no accredited investor paperwork necessary, none of that nonsense. If you are a course member, the minimum is going to be $5,000. And I'm doing this separation on purpose because I believe that individuals who invest in their future in learning perspective on finance rather than people who think that necessarily, I can't learn anything from anyone else. I personally believe that these are kind of the investors that we really want to give a special opportunity to. And so we're lowering the minimum required for course members. Now, that's the non-accredited update. Worst case scenario, this ends up getting pushed back to Feb. Worst case, March, something like this. The downside with this time frame is it's all subject to the Security and Exchange Commission. It's actually not up to us. It's up to how much commentary they come back with and how often they come back with more requests, which is okay because I'd rather the SEC ask us all their questions in the world first rather than come back later with a bunch of concerns or questions, right, while we're operating. We don't want that. We want to deal with all of that up front. So really important that we deal with that up front. which is very, very exciting to us that we're going to get that handled. Now, what's going on with the Federal Reserve, Ross Gerber taking our money, and locations that we're thinking about investing in? All right, so here's the thing. First, when it comes to the Federal Reserve, we have to remember that we need to be prepared for the Federal Reserve to potentially continue to raise rates, right? So there's option number one. Option number one is Fed raises rates more, raises more. All right, and then option number two is the pivot. And that's option two. Now, we have to be prepared for both of these scenarios, and I'd just like to explain the strategy for each of these. So first, if the Fed continues to aggressively combat inflation, whether they're right to do so or not, they just continued their aggressive push towards raising rates, and rates end up going higher than markets are expecting, then the answer that we need to focus on is this. Oh, that's a squeaky marker. Patience. We have to focus on patience. The reason we focus on patience is because the more the Federal Reserve acts aggressively, the more pressure will come onto real estate valuations, and the more we expect to see real estate valuations pushed down. And the longer we wait, the better. So patience is really, really important with an aggressive Fed. However, there is also the potential for a Federal Reserve pivot. This is where the Federal Reserve quickly pivots somewhere around maybe January to March, and we see not only a substantial pause, but we start seeing the Fed plant seeds for a real U-turn and potentially actually reducing rates sooner than the market expects. This is going to lead to a little bit more urgency. And the reason for that sort of urgency is as soon as mortgage rates start plummeting, we expect to see some form of a floor established under valuations for real estate. And so the Fed flip-flop is going to be really critical in watching the Fed's timing, which I personally, honestly, don't think anybody thinks about or dreams about the Federal Reserve as much as I do. That sounds really weird, but it's true. Watching them like a hawk is actually critical for how and when we launch. So this becomes very important. But in addition to that, it's also going to affect where we're going to invest in real estate. So I'd like to present, which I haven't done before, some of the initial locations and my initial rationale for targeting these regions. Okay, these are not definites yet. We might end up killing some of these ideas, but these are some of the areas that I'm highlighting at first because of what's happening with market timing, and this I expect to change. So, when I say I expect this to change, I don't expect it to flip-flop. I expect HouseHack to start in one area and then move to another. In fact, let me just make that very, very clear. I think it's very, very important that HouseHack have sort of an initial location, and then we basically rotate outside of that location, and then we expand, and then we expand. I think that's very important because, first of all, travel times are then smaller for not only myself, but executive staff. It's easier then for us to check in on our local staff, but it also makes us more of a local expert, which is very, very critical to make sure we're getting absolutely the best deals, and then we expand from where we're good into new areas and expand the model. So, first, we know this. We know that companies like Pulte Homes are telling us that they are aggressively discounting inventory. This is how we know we're not at the bottom yet, right? We know that properties are being dumped because companies are saying they can't be margin proud. This is a really great opportunity for us. In addition, we hear things like this. We hear that Western markets are facing the toughest damage right now, whereas areas like the Southeast and Florida and Texas are actually performing better as people are looking for more attractive climates, attractive job growth, and a focus on really the Sun Belt region. And this creates a very interesting opportunity because I'm a big fan of following jobs. Not only am I a big fan of following jobs, I'm a big fan of following where new offices are being built. We want to stay away from those 1960s, 1970s style offices that are too dark and don't support modern infrastructure like modern internet speeds or modern floor plans. So we need to be around newer office buildings. You see this same transformation happening in New York City, where you've got a lot of folks moving west within Manhattan because the easterly buildings are just the 1960s, 70s junk buildings that nobody wants anymore. So people are moving over to areas that used to be like meatpacking areas like Greenwich Village or whatever, that are turning into more modern office areas. So while we're not necessarily investing in Manhattan at this point, the point is we want to focus on where are those new office developments coming, and a lot of this is not necessarily only in areas of the Sun Belt. We see substantial job growth and new offices and attractive climates in Western markets as well. But Western markets are getting hit more because of sort of that pandemic move away, where more people now than ever before can work from home, and so that people are able to move to less expensive areas. And so these are trends that we really want to pay attention to. We want to be in the Southeast and we want to be in the Sun Belt. But if we can find markets in the West that have already been substantially discounted and have attractive climates and have job growth, then those areas could get punished the most now under high interest rates, but could have some of the best potential rebounds. Now, to be determined, we don't know all of that with certainty, but here's what we're looking at right now. Let's go ahead and jump on over to this particular chart, and this is the CoreLogic Case-Shiller report. And one of the phenomenal things about this chart is it tells us in August, both non-seasonally adjusted and seasonally adjusted, exactly where most of the pain is. And you can see highlighted here in pink are actually your real pained areas. Take a look at that. Dallas, Denver, Las Vegas, Phoenix, Portland, San Diego, San Francisco, and Seattle. Whereas the areas that are not yet suffering a lot of pain are Tampa, Miami, Detroit, Cleveland, Chicago, Charlotte, Boston, and Atlanta. Now, this creates a really interesting opportunity, because if we can do the following, watch this. Let's go ahead. There we go. Get that out of the way. If we can do the following, watch this. If we can have a mandate of focusing where are the new jobs and the new office buildings, right? If we can then also focus on attractive climates, very important, I believe, and we could start where the most pain is once we see a bottom forming, right? Start where pain is. Then we can move over to the areas that haven't been hit as hard in the future. So move east in future. So what does that potentially mean for us? Well, it potentially means if this here is a map of the United States, it's a pretty terrible example of the United States, but oh well. What it potentially means is we start investing here and we make our way over, probably will look like somewhat like this, right? And then maybe we make our way up something like this. These areas could be the most attractive because they could end up seeing the most pain first, which could end up being areas like Salt Lake City, Boise, Denver, San Diego, Ventura County, Santa Barbara, Portland, Seattle. You've got Phoenix and Las Vegas. And then maybe you move over to Dallas, like we saw on that Case-Shiller report. And in the future, after we sort of loop around here, maybe then we end up in like Detroit after potentially considering Manhattan. Do we ever consider Atlanta? How about those Florida locations, the Tampa, the Fort Lauderdale, the Miami, right? This is a trajectory that I'm expecting right now. This could obviously change, but I like looking at where the most pain is, and then making sure that we only go to pained areas if we actually still see a flow of strong jobs and new offices, an attractive climate. This area right here has probably the most attractive climate in America. However, people do seem to prefer warm over cold, so that becomes your next attractive climate here. But what this really does is it gives us an expansion plan to where we could really become perfect in sort of the southwest region first, and then move over across the United States. Now, this could entirely change, and it really depends on how markets evolve, because the last thing we want to do is go into an area that turns dead or stale. For example, there are some cities that did really, really well in the pandemic, but I think there are zombie cities. Now, a zombie city is something that is so critical to understand. A zombie city is usually defined by a city that has really, really high cash flow and on paper looks really, really amazing, but it usually only has one job provider, right? And if that one job provider, whether it's an energy facility or it's a government facility or it's a private enterprise, if that one job provider goes away, the town basically goes bankrupt. And the reason you tend to see high cash flow in some of these potential zombie areas, oftentimes with low population growth, is because there's so much risk associated with those areas. See, cash flow is actually a measure of risk. Usually, the more cash flow, the more risky. Now, you can change that by getting good deals. I can go into a low cash flow area and get a high cash flow property by either changing its use or just getting a good deal, or both. But as sort of a broad brush stroke, high cash flow usually associated with higher risk, low cash flow usually associated with lower risk. So you have to balance this by making sure you're getting good deals, whether those are wedge deals, wedge rent deals, wedge condition deals, fixer-uppers, whatever it may be. So those are important things that we have to pay attention to. Now, next, what's up with this Ross Gerber guy? Why is Ross Gerber taking all of our money? Well, he's not taking all of our money, but he's going to be taking a big chunk of our money. And we actually have a very beautiful partnership. And so we're going to be sending him a check for about $21 million. Again, not all of our money, but a big check. We're going to be sending him about $21 million. And we're asking him to invest that $21 million into treasuries. Now, Ross is not only a financial advisor, I'm a financial advisor as well, but Ross also runs an investment advisory firm. And we can retain them, and Ross is giving us an extremely good deal. Not only is he a board member at HouseHack, but he's giving us an extremely good deal on the management of this funding. But we're providing him this to invest in treasuries. And we expect that over the next year, at about 4.25%, we would be able to make about $892,500. Not guaranteed, obviously, depends when we invest. But obviously, when we go into secure, like zero risk treasuries, we do expect to get roughly something around this in terms of funding, or not funding as a return. We would be getting almost $900,000 here, risk-free, by October 2023. Now, the cool thing is, we're not purposefully putting all of our funds in this, and new funding will maybe go into 3 or 6 month treasuries, so we have those available sooner. See, what we're actually going to be doing is something like a first in, last out approach. For those of you who are into accounting, that's first in, last out. FILO. Oh, you can't even see that. I wrote it too high. The FILO approach. There you go. And the reason for that is the first in money, we want to lock in for longer terms, like a longer time frame. So these could, for example, be 12-month treasuries. Our next batch of, if this is, let's say, we'll call this B1 right here, right? If we go to B2 and we get our next $10 million, we might put that into 6-month treasuries. If we then go to B3, and this is our non-accredited round, and we end up raising $50 million, we might end up putting that also into 6-month treasuries. Because see, if we put 6 months in, these come out October, let's say these end up going in November, and they come out somewhere around May, and then these come in January, February, and end up coming out in August. what you could actually see is what we're doing is building a laddered portfolio where we're getting 900K about on 21 mil over here. We'll get a return on this money with 6-month treasuries. We'll get a return on this money with 6-month treasuries. And we're really setting ourselves up to have the money available to go shopping by Q3 of 2023. Of course, that number could change. If we have an aggressive Fed, that could end up becoming Q4. If we have a dovish Fed, that could end up becoming Q2. Either way, with new money coming in, we could use new money first. And the old money we could park into treasuries to make sure that we are maximizing our return to shareholders. So this is just an example of how we're going to do this. And rather than, look, I know I can do this as well. I can throw this money into treasuries by going to treasurydirect.gov. But rather than manage that myself, I think it's more important for me to be focused on where are we going to buy and building those relationships with agents around the country so that way we can get the best deals. Let Ross do something that he's already done as a professional extremely well, and potentially this becomes something that's mutually beneficial to both companies where, for example, Ross is able to benefit because of the association to HouseHack, but also HouseHack is able to benefit because we have a professional money manager who's been doing this for over 30 years, holding on to and laddering our treasuries for us, which could potentially attract more funding to us. Okay, now let's talk about average deal size. So average deal size probably for units will probably be somewhere between $150,000 to $300,000 per door when we're looking at units. And I would expect that single family would probably be around $500,000 to $600,000. So we're not trying to go luxury here. We're trying to go middle to upper middle, right? I would say probably lower class would be somewhere around $100,000 a door for units, maybe $300,000 or less for single families. That's not a diss. I'm just trying to make sure it's clear that this is more of the middle approach, whereas upper income would be like $500K a door for units and maybe like $1 million a door for single family. And I just want to make it very clear where our focus is. I've always believed that the most liquidity you could have in real estate is focusing on the median. That's like your typical 3-bedroom, 2-bath house, post-war kind of house where we have real opportunities to fix and renovate and then rent out. Remember, we're not flipping, and I think that's one of the big misconceptions that I hear of a lot is people think that somehow we're flippers or somehow we're going to suffer like Open Door. We're not like Open Door. Open Door doesn't rent out properties. In my opinion, one of the big differences between us and Open Door is Open Door seems to have thousands of staff who buy properties for over market value just to buy them, to get a 6% commission fee, and then just try to resell them. And they're really trying to profit off of the commission model. Whereas what we're trying to do is make sure we get a good equity boost. So for example, if I go buy a home for $500,000, and that home is in a $700,000 neighborhood, well, now I have optionality. Let's say that the cost to renovate that property is $50,000. That extra $150,000 right here, this is profit. But it's not realized profit because obviously we would have selling fees if we were to sell it. This profit, that $150,000, is actually just untaxed equity. This is really good because it increases the net value, the net asset value of the company. The book value of the company goes up without us having to be taxed, which is great. And now we have a $700,000 property that we have optionality for. We have a lot of options. The first things that we could do is we could do short-term rentals, which we have to be careful here with short-term rentals because we do see demand, not according to Airbnb in their earnings calls, demand is going up, but there's a lot of talk that demand in areas, and I'm starting to see this as well, is going down. Could be seasonal, but it's something to pay attention to. And then, of course, we could do long-term rental, and we could also do what's sort of called a flex-term rental. It's sort of like a medium-term rental, but that's a little bit more of something in the future. And then, of course, when we have a portfolio of these, we could do some incredible things as well. That's really a topic for a different video, whether that's, selling equity to pension funds or whatever. The point is it would all benefit HouseHack, whatever we decide to do. But this is how we get optionality, is getting a good deal at an under market value. Now we're into a deal for $550, but we're able to get long-term rents or short-term rental rents on a $700,000 property with having untaxed equity within the actual company. So some really good opportunities. Now, another question that I frequently get has to do with international investors. Look, if you're international, you can invest. If you're international, just get us a CPA letter, get us an attorney letter. If you are international non-accredited, same thing, you just have to wait for the non-accredited round. But this is a sort of a full update for you on HouseHack, on some of our latest plans and intentions, and I hope you found it helpful. Remember, go to househack.com to learn more. This video can't be a solicitation, but househack.com and the prospectus there. Prospectus is your solicitation. You can learn more there. If you have questions, go to Discord, metkevin.com/chat, ask questions there. And of course, get your letter. The easiest thing to do is if you're accredited, get your letter. And make sure you go to househack.investready.com to get your letter, or just post your W-2s and tax returns by tomorrow on househack.com by hitting that apply button. Upload your documents and wire by the end of the week to get your maximized warrants. Thanks so much for watching, and we'll see you in the next one. Bye.